This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today in the podcast, I have Tom Dorsey of Dorsey Wright. Tom specializes in technical analysis, specifically point and figure and relative strength. A little different from my world, but in the same headspace. I think you'll enjoy.
Tom Dorsey.
Hey, Tom. Mike Covel. How are you?
Fine, thank you, Mike. What's up, buddy?
Not too much. We've never spoken before, have we?
I thought we had at some point in time, but maybe not. Yeah. I speak to probably 50 people a day.
Well, I figured since we were right up this technical analysis direction that it was high time that we had a conversation.
Sounds good.
So listen, let me jump into your beginnings. So Dorsey Wright, and I'm going to let you explain your strategy and your thinking. But what I'd love to do is maybe the firm was started in 1987. So when did you first, maybe you could go back to your early beginnings of markets, how you got introduced, and maybe how you came at the idea of technical analysis, or how you often point out the idea of finding supply and demand. How did you first come into technical analysis?
Well, it was totally accidental. In my book, I mentioned that I was a stockbroker at Merrill Lynch back in the mid-'70s. And, pretty much what you did as a stockbroker in the mid-'70s, especially when you started as I did, exactly at the end of the crash of 73, 74, I began prospecting people at that point in time, never really even knowing that a total meltdown had just happened. And investors had lost probably 60% of their investable capital. I'm just now sitting in the seat calling up Mr. Jones in my 20s, telling him I'm going to save him. I got the idea. And they didn't want to hear that.
What idea were you telling him at that point in time?
Merrill Lynch research. Okay. I'm riding in on the white horse, man. I'm going to save you. I've got Merrill Lynch research to sell you. Well, I didn't realize that had played out already. Here I was, a 20-something, just came back from Merrill Lynch training school, learned how to sell, sat down with a phone book, and started dialing for dollars. And after the first year, it was very, very difficult. And I sat back, and I still didn't even realize we had just gone through a bear market and what that meant. None of us did. And I decided, if I'm going to be successful in this business, I need to become an expert at something. I can't be a general practitioner and just try to be everything to every person. So the option business just debuted 1 year beforehand in April of 1974. And I said, that's going to be my direction, is options. So I began to learn everything I could possibly learn about options. There was very little written. I went home on weekends with a legal pad and a pencil and worked things out mathematically until finally I really understood them. Long story short, Wheat First Securities, which was a very large regional back then, it's now part of Wells Fargo, came to me and offered me the opportunity to develop and manage their first option strategy department. And this is where it all begins. I thought about that very hard, and I really loved being a stockbroker, but this was an opportunity where I would be able to develop and make my own name. So I went across the street and I sat down with open checkbook, carte blanche, do whatever I needed to do to start that option department. And I got honest with myself, and I said, okay, after being a broker for about 5 years at Merrill Lynch, what do you know about the market? And the answer was nothing. I could do what I was told, when I was told, how I was told, and then stop. You could not recommend anything to a customer that Merrill Lynch didn't have a buy recommendation on it or research on it. So you did pretty much what the stack of research that came down from New York each day. That's what you recommended.
And has that changed? Has that changed today much?
No, it certainly hasn't. It certainly has not. It certainly has not. But back then, while I'm starting this department, I realized that, if I was going to be just like the other people at Merrill Lynch and running this option department, if research liked IBM and I said, let's buy IBM calls, then I'm going to be an also-ran. I'm not going to be anything. I need to be self-contained in my department. I need to make a name for myself. And I said, okay, then since you don't have any really idea of strategy on the market and sectors and stocks, you need to hire someone who does. So a long story short, I searched high and low at Wheat First Securities, came up with the name Steve Kane from our Charlotte, North Carolina branch. I hired him. He moved his family up to Richmond, Virginia, and this is where my life changes. He brought with him a little red and white book called The 3-Point Reversal Method of Point and Figure Stock Market Trading. And it was written in 1947 by A.W. Cohen. And he said, I'd like you to read this book so you'll understand the template in my mind. You'll know how I think. When I come to you with a sector or stock that I think we should recommend options on or whatever, you'll know where this thought process is coming from. I said, fine, I'll be happy to do that. So I took that book to Virginia Beach with my wife that weekend, opened the first paragraph of the introduction, and my life changed totally. And this is where the technical analysis comes to me by this one evening and reading that introduction, and it brought me back to my economics education in the university. And the most important class that I ever had in university was Economics 101. And it took me right back to that. And all of a sudden, I saw Wall Street for what it was. Totally clear. All the clouds were cleared away. I saw Wall Street for what it was. That I had, if there was a holy grail, I'd come across it. And all of the fundamental research and all of the 3P suits and all of the MIT and Harvard and Yale and all those guys writing fundamental reports meant absolutely nothing.
Does that mean you had a 3P suit at one point in time?
Absolutely. I used to wear, we had to wear a suit. When I was a broker at Merrill Lynch, you had to wear a suit to work, not a coat and tie. You had to wear a suit, and you had to leave the jacket on all day, no matter how hot it got in there. So yeah, I used to go with the 3P suit.
Let me let you jump in. My world, having written several books on the subject of trend following, and we're in the same direction, we're in the same headspace. But I think for my audience, I might let you at least give. I know you've got a book out there that people could take a look at, but maybe I can let you give them a broad overview of point and figure so they understand your style of technical analysis.
Yeah. When I read that first paragraph of the introduction, it brought me back to Economics 101. And all of a sudden I came to the understanding, really, if there are more buyers than sellers willing to sell, price must rise. If there are more sellers than buyers willing to buy, price must decline. If buying and selling is equal, price must remain the same. There is nothing else. I don't care who writes the report. I don't care where they graduated from college. I don't care how thick that report is. It doesn't matter. If there are if the balance between supply and demand is not in demand's favor, the price of the stock will not rise. So why don't I go directly to that point where the battle between supply and demand takes place? Why should I bother going before that and reading all of the research as meaningless when I can go right to the source? And that's what this did. It brought me right to the source. And this was a method created by Charles Dow back in the late 1800s simply as a logical, organized way of recording that imbalance between supply and demand. So it's very much like a tennis match. The point and figure chart is made up of X's and O's, which is very different than any other methodology in technical analysis. The X's represent a stock rising, the O represents a stock declining, and neither the X there can never be an X and O in the same column. So it's really like a tennis match where one player wins a game and another player wins a game and another player wins a game and a player wins a set, and eventually he wins enough sets and he wins the match. As the stock moves back and forth in X's and O's, what happens is that's kind of a random movement. It moves back and forth in X's and O's. It's like a volley of a tennis match going back and forth until finally either demand or supply takes control and a top is exceeded or a bottom is exceeded, suggesting that demand is in control of that stock. You can't go any further than that. There is no predicting things and having a crystal ball and that type of thing. We have indicators that give us a handle on whether the offensive team is on the field or the defensive team is on the field. We have comparisons on relative strength on what asset class is the strongest of them all. And then within that asset class, we try to find the sectors that are the strongest within that asset class. And within the sectors, we try to find the stocks that are the strongest within the sector. And that's how we go about it. And the point and figure chart is very easily computerizable because computers can understand ones and O's. They certainly can understand X's and O's. So everything that we do has been rendered to a computer. It's the same stuff we would do by hand, but we do multi-millions of calculations billions of calculations every single night, comparing and contrasting the world. So it starts from the basis of supply and demand of the chart pattern. We then compare and contrast charts one with each other, relative strength, dividing one thing by another, which creates a number. That number is then plotted on a chart, giving it life, and that's really how we go about doing it.
You made an interesting point there. You talked about, okay, you can do this by hand if you so desire, but you automate the strategy. I find often when quantitative strategies catch criticism, you always see these snarky remarks in the publications, whatever the publication might be, black box, black box, black box.
Yep.
And I find it silly because all your calculations in assorted computer programs are doing is simply calculating the thoughts and the systems that you guys have jotted out on paper, and you've just automated it to make life easy, which is it's just an automation. It's an automation tool, and I find it amazing that I still have not figured out whether the snarky black box thing is because they don't want to understand, or they do understand. They just want to kind of get a shot in. Do you ever think about that?
Well, there are black boxes and there are black boxes. What people think of when they think of a black box is just take for instance, there are guys who actually run money, and they say, okay, if let's say Mrs. Yellen says the word "that" 5 times in a row in the first paragraph of her statement about the union and financials, whatever of the union, if she says that 7 times, then we need to go long stocks. That's the black box stuff people don't want to be involved in. And that's the data mining that people don't want to be involved in. What they don't understand is, just like you said just now, all we're doing is making something simple that we do by hand. The rite of passage at Dorsey, Wright Associates 27 years ago was to do the relative strength charts by hand. And how do we do relative strength charts? We divide one thing by another. I can teach that to a 4th grader in 10 minutes here. And I could teach a 4th grader to manage a portfolio in 10 minutes.
Now, when you say you could teach a 4th grader, though, you are by definition, you are saying that some of the brightest traders, money managers, etc., with the MIT, Harvard, Princeton degrees, and schooled in the fine arts of fundamental analysis, you're kind of saying. Are you comparing them to 4th graders? I'm giving you a hard time.
I'm saying the 4th grader probably has a clearer outlook. In fact, Tammy DeRozier and myself, Tammy's my chief operating officer here, we went to Gates Elementary School in Richmond, Virginia, and these weren't 4th graders, they were 7th graders. I have to increase it by 3. These were 7th graders, and we taught them our process in 40 minutes.
And you find when kids that age have not had a chance to be burdened by all the thinking that you can study all this fundamental analysis and then you could predict the world, but when you sit down with you and explain to them, hey guys, gals, you really can't do that, but here's a way to navigate the chaos anyways.
Yes, we have even gone into classes. Susan, what class did we go into with the pennies? What grade were they?
3rd graders. Mary Ellen.
Was 3rd graders? Yeah, it was 3rd graders. My cousin had a class of 3rd graders here. We went into this class, and we brought pennies with us, and we brought Hershey's candy bars with us. And we passed out the pennies. And we gave some kids more pennies than other kids. Now, they didn't know that. And then we let them begin bidding on the chocolate. It didn't take them very long before the group found out or realized that somebody had more money than they did. So they immediately began to form cartels where they put groups together and said, we can fight this guy over here that's got all his money, is winning the candy, if we get together. And we'll buy the candy and split it. These were 3rd graders. And we didn't tell them anything about cartels and how to go about doing that type of thing. They picked it up in 30 minutes and understood how the exchanges worked. and were actually bidding on the chocolate. And then when we told them, all of a sudden we found some bad chocolate that was tainted and it could make you sick. All of a sudden, the supply and demand relationship changed. Supply overtook demand, and the price of the chocolate went down. And these kids got it, and they didn't even have to go to school to get it. They inherently understood it.
So the big picture question for you is: this world that you and I occupy, is this ever going to make it across to mainstream audiences, or are we just going to continue for decades upon decades into the future, people believing these talking heads and these high-paid analysts that they can predict the future?
Well, that's human nature. And what's going to happen is technology will democratize this whole thing. Back in 1975, when I was a stockbroker at Merrill Lynch, all of a sudden Charles Schwab came out in 1975. And the discounting operation was in force then. Charles Schwab is online, and we looked at Charles Schwab and we laughed at him. We said, come on. I've got the three-piece suit. If you want a Standard & Poor's sheet, you got to call me. If you want to buy a stock, you need to call me. If you want to know even what a stock is, you got to call me, because I am the keeper of all information. And Charles Schwab comes online and says, hey, you don't need to do that. You can execute through me. But we tried to hold our commissions as high as we possibly could for as long as we possibly could. But that creative destruction that Charles Schwab brought to the markets changed the world. Now we look back and say, okay, back then in 1975, Merrill Lynch was saying, there's no way you can do it, Mr. Jones. You need us to do it. Today, nobody needs these guys to do it. They have discount operations. The commissions have come down. Fees have come down significantly. Computers operate now. Most brokers have gone to modern portfolio theory, which doesn't work, except it keeps the lawsuits down. And it's something that's computerizable. Now, to show you what's happened with modern portfolio theory, what brokers have educated their customers in for the last 25 years, now has been proven and totally discredited that it just doesn't work. But what do? They keep pushing it. Well, all of a sudden some firms began to come online in California. In fact, most people don't realize there is no more Wall Street. It's now California Street. Wall Street is just a place where orders are executed. No thought process goes there anymore. All the thought process is in Silicon Valley and on California Street in San Francisco. So all of a sudden these companies start coming out. And it's like the Lilliputians around Gulliver. And these are companies like SigFig.com, Wealthfront.com, MarketRiders.com, Smart401k.com, Betterment.com. I could go down the line on all these companies that now offer modern portfolio theory for 25 basis points. And the broker is offering it for 200 basis points. But the difference is the broker says, look, I'm here to help you. I'm your personal trainer. These companies say, look, just turn your money over to us. We're totally safe. We will manage it, do the same thing the broker does for 25 basis points. But that was until a few weeks ago. And then, as I understand, SigFig.com has gone to $10 a month. And Betterment has reduced from 25 basis points to 15 basis points. And there is a company that I know of, and I can't mention their name, that shortly will be coming out to do it for nothing. So that shows you what technology is doing. So when you sit back and say, well, the question then would be, how long will it take Mr. Jones to figure it out that he can have this same thing done where he's being charged 200 basis points done for nothing at this company? Well, let's say right now, in reality right now, at Betterment.com for 15 basis points. How long will that take? Well, that's going to take a hell of a marketing job. It's going to take a lot of people out there educating customers into what exchange-traded funds are, how they work. It's a big learning curve. How long did it take people to understand that they could execute online and do it themselves? Well, 1975, here we are, 2014, and still there's a lot of room to be made for the discounters to get people to understand how to manage their own money and do it through them. John Bogle has come a long way, and John Bogle was right. I mean, people can just buy an index. I think it's 75% of all money managers in the world never outperform the S&P 500. And if they even wanted to go one step further and said, let's say the equal-weighted S&P 500, probably 90% of all money managers never outperform that.
I was just looking at, I think it was the Texas Teachers Pension Fund the other day, and looking at their underperformance of of typical indexes is just amazing. And the amount of fees they pay out, just astronomical. And then when you go through the funds that they're paying all these fees to, it is just fundamental analysis on top of fundamental analysis. There's a couple quants in there, but by and large, it's all the fundamental stuff. Yeah.
Nobody cares.
Yeah.
Nobody cares. It's just easier to say, look, just give it to them, do it. I don't care if I underperform, whatever. Just do all the back office and handle that properly, and that's it.
Yeah. I guess what I'm curious about is that you're a pretty frank guy. You seem like a pretty nice guy, but I'm guessing your views about the brokerage space causes some people to sometimes be like, gosh, I wish Tom would just be quiet.
Well, I think you're probably right, but our clients, see the difference in the brokerage space in general and the people who have gravitated to us for the last 27 years as clients, our clients are the craftsmen. These are the people, number one, to be a client of Dorsey, Wright Associates, you have to be willing to be educated and learn what we do, and then be supported by what we do with our systems. And what that means is you've got a much more well-educated advisor who's helping his customer, who are clients of ours. Then it leaves the vast majority of the rest of them out there that do modern portfolio theory and really function like a financial planner. I had one of my clients talk to me. He said, Tom, I'm a financial planner. And I said, define that for me. And he said, well, I'm really like a personal trainer. You know, I make sure that the customer puts his money in every month, doesn't take out too much, that type of thing. And I thought to myself, well, okay, that is what a personal trainer does. You know, when you go into personal training, you get a personal trainer, he makes sure you do your push-ups and your sit-ups and do your cardio and that type of thing. And maybe that's the function of the advisor today, is to be a personal trainer for customers who need someone to say, get down and give me 10.
Tom, I think you've given the overview that I wanted today. It was kind of a little bit different for me, a little bit different than my world, but my audience is a lot of different topics and different perspectives on my podcast. So I appreciate you taking the time today. Where is the best place? I'm assuming it's going to be DorseyWright.com. Is that the best place for everybody to go to learn more information?
Yeah, I would say that www.DorseyWright.com. Exactly. That would be the best place.
Well, Tom, listen, I appreciate you taking the time today, and hopefully we will catch up in the near future.
You're welcome.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.